Hello and welcome to our next edition of our GlobalView webinar. My name is Martina Bozadzhieva and I'm Chief Research Officer at FrontierView. And I'm joined here today by the star of the show, Elizabeth Rust, our Senior Analyst for Global Economics. Hi Elizabeth, welcome. Lots for us to discuss today.
As always.
As always. So the global economy, of course, remains somewhat unpredictable and volatile, but there were a couple of topics I was hoping we could cover today. First, I wanted to start with China, and then we'll turn to the US and the interest rate situation there as well. But also for our listeners, I guess one of the big things we wanted to flag is that we've made some changes to our China assumptions and scenarios. We'll go deeper into those and also their global implications, but just to give everybody the headline view, we are now assuming as our base case that China does not reopen or does not end its zero COVID policy in 2023. I know, quite controversial, so lots, I think, for us to unpack there. And as a result, plus taking into account some of the real estate scenarios that we're working on, we expect that growth in China next year will be somewhere around the 3.5% point. Year on year, coming off of about 2.6% GDP growth for this year. So way, way below historical averages, stated goals of the Chinese Communist Party, and of course, taking into account quite a lot of pressures on the economy from zero COVID and other factors. So this is, I guess, the headline view, Elizabeth, but how should we think about what some of the implications of this might be for companies, for their global operations and global assumptions as well?
Sure. Yeah, as you indicate, this marks a really big shift in our view. Our base case view prior to this was something like a mid-2023 opening. Interestingly, that's already quite different from what the base case view seemed to be among our client base. Many clients have more or less been operating under the assumption that we would see a reopening even later this year after the conclusion of the Party Congress. So this is obviously warrants a big shift in the outlook. Some high-level sort of global implications that are being worked now into our base case assumptions for the global outlook. Obviously, that downshift in Chinese growth assumptions for next year, it's a big downshift. So we were assuming 5.0% growth for 2023, and now we're at 3.5% growth. Which is now a little bit lower than consensus, but still, not really an out there view increasingly, given the general realization that China will likely persist with zero COVID for much longer than earlier anticipated. So already that downgrade in global growth in Chinese growth expectations necessitates a bit of a downgrade in global growth expectations. We're not releasing a new number there yet. So we're still expecting 1.6% global growth for next year, which to some extent had already been incorporating some expectations of deteriorating Chinese growth and is already quite a bit below overall consensus for growth next year. So it paints a pretty pessimistic picture for overall growth next year that has knock-on effects for overall global demand for manufactured goods, given a likely slowdown in China's own manufacturing capacity. It translates to a slowdown in demand for semi-finished manufactured goods. And it's also likely to push down commodity prices a little bit lower than what most have been expecting. So those are some early kind of implications to draw from this change in view.
Yeah, and your point about what the assumptions are of multinationals is quite important because it is true, and we're part of a lot of leadership team presentations and planning meetings for our clients, and many people are still expecting that after the Party Congress, which is happening, I guess, starts end of this week, there is going to be some announcement around the reopening. We think otherwise, and of course we feel quite a bit of pressure on that view, but I think there's something to be said about if China can sustain zero COVID, first, it's going to avoid what is in any scenario going to be a pretty traumatic reopening, which I think is not really on the radar of a lot of people, but it would involve quite significant outbreaks of COVID-19, even with significant vaccination, and likely substantial pressure on the healthcare system, as well as, frankly, deaths, just given the experience that any other country had when it started to reopen. And so if China is able to sustain zero COVID, you are going to avoid that sort of scenario. And the issues are going to be really around this continued disconnect between China operations and global operations with very limited in and out travel. That is a problem as kind of it becomes harder to really get a good sense of what's happening on the ground for multinationals. Of course, you are still facing the periodic risk of rapid lockdowns, unpredictable and expected lockdowns that affect local consumption in big urban areas in particular, or manufacturing facilities. But it's not something that companies haven't had to deal with for all of this year. So in a way, it's more of the same, which is maybe not such bad news, I guess. I don't know, what's your take on how to interpret this?
I'm interested in asking you a question about this, Martina, since you've been talking quite a bit with our China and APAC teams about this the last several weeks. Both of us have been sharing this new view with clients. And I'm just curious to know a little bit more about the shift in reasoning, why we don't think there will be an immediate reopening after the Party Congress. I think when I share this view with clients, the pushback I often hear, some of these clients obviously operating in China and hearing rumors or having certain notions about the timeline here. I think common kind of pushback against that comes from the idea that, after Xi has shored up power following the Party Congress and has secured a third term, that there will be less pressure to continue with zero COVID, and so at that point China can reopen. Another point often made is that China simply can't sustain zero COVID through all of next year. That between all of the headwinds its economy is facing, lots of troubles in the property market, slowing growth all around, that it will need to reopen in order to juice consumer spending and kind of protect its own debt dynamics as well. So why do we think that? Why is it kind of what explains this shift in our view in response to some of those points made?
Yeah, great question. And I have a couple of things to say to this. Obviously, we could go in a lot more detail, but it starts with really understanding what it means to reopen, because China is not closed right now. China is not in the lockdown that we saw in Wuhan after the initial outbreak, or even in the types of lockdowns that we saw at the height of the pandemic in, say, Europe. It's mostly open. There's constant testing, which is very disruptive, of course. But if you're test negative, then you can go about your business, and you're just at the constant risk of being locked down, but it doesn't mean you're permanently in some sort of lockdown. So that's one thing that's important to highlight, because China has had a fundamentally different experience of the pandemic than the rest of the world. They didn't have the large-scale outbreaks and, frankly, loss of life that a lot of countries did. There's also not that existing immunity from people who've gone through COVID that you have in other countries. So when we run the numbers based on the science of COVID, you're looking at any sort of reopening, even with vaccination of vulnerable populations, which currently the levels are quite low, anywhere from several 100,000 to several million deaths, and possibly happening very quickly because, as we know, this virus spreads exponentially. So when you look at the science, it's hard to see how this is going to be just, oh, we just give up on zero COVID. This is a moment in which you start seeing significant outbreaks. You start seeing kind of moments of panic and fear and, frankly, again, loss of life. And it's not smooth sailing is the way to put it. Now, we thought that from a government perspective, to reopen, they would want to minimize this disruption by vaccinating as much of the population with the most effective vaccines out there, which are mRNA vaccines. And we've been waiting to see China approve an mRNA vaccine, its own or otherwise, and begin that vaccination process. And nothing of that has happened. There's just no sign whatsoever, neither in the messaging, on the policy statements, no approvals. There's no hard evidence that they're preparing for this sort of scenario. And that gives us kind of confidence in saying that they're not getting in any shape or form ready to manage this outbreak, and they understand the impact and consequences of it. So I think it's important for us to think about kind of in practice what this looks like and why it's so hard for them to get out of this situation. Number one. And the second thing I would say is that in many countries, politics eats economics for breakfast any day of the week. Countries can do, as we have seen, Venezuela, Russia recently, and any number of countries. Political considerations can trump economic prudence in big and complex places. And China is no exception. This is first and foremost a political priority to whether you're looking at it as a hallmark Xi Jinping policy, so quite linked to his own prestige, whether you're looking at they're protecting lives and they're okay protecting lives in exchange for lower growth. There's different political considerations, but clearly politics is trumping economics right now, and we should not assume that economics wins this argument. And that's another reason why we feel more confident in this view.
You make this point throughout when we talk about reopening, whenever it happens, and again, most likely not next year, or at least not until very late next year, that the process is going to be traumatizing for China, that it will, even with a vaccine, likely result in waves of cases and deaths much greater than anything China has faced up until this point. It also kind of, putting it that way, reminds me about what I perceive to be the general assumption among our client base and many other observers, that reopening is a good scenario and one that we should be expecting and hoping happens as quickly as possible. Obviously, within China, there's reason to cast doubt on that, obviously politically and socially, if we do see waves of deaths, but also economically, there are costs associated with reopening. You know, we've seen generally around the world, when countries reopen, you tend to get a spike in demand and inflation. China has had very low inflation this entire time, and a lot of it has to do with the fact that it's been quite closed. So that's one thing that, you know, we'll have to watch and think about if we do start to see China reopen at some point. It's also not necessarily a huge win immediately for the rest of the world when China reopens, due to all those factors. Also, the fact that China remaining relatively closed has been probably the biggest factor keeping down commodity prices. If you think about, China accounts for about 15% of global oil consumption, and so oil prices would be way, way higher today if China were open as normal. So whenever they reopen, you'd likely see a spike in commodity prices that has knock-on effects for inflation. So I think all told, our view is a little bit more nuanced on the nature of reopening, and incorporates the assumption that reopening will entail benefits and costs. And that's the same also for multinational operations in China.
I think that's exactly right. It's definitely something that companies need to think through all of these scenarios from a practical perspective, how they manage them, because they will have very operational implications for them as well. So I just wanted to spend 2 minutes talking a little bit about inflation in the US. There was a recent report. Tell us kind of what we saw there and how that affects how we think about the inevitable strengthening of the US dollar that just keeps going and going.
Yeah. So yesterday we saw the monthly CPI inflation report released from the US Bureau of Labor Statistics. And this increasingly is the most closely watched economic data release in the world because of what you say. It basically tells us what's going to happen with Fed policy, and Fed policy is increasingly driving so much of the global outlook now. So in terms of what we saw headline year-on-year CPI inflation tick down slightly from 8.3% in August to 8.2% in September, but that doesn't really tell the whole story. Overall, it was a report that communicated that inflationary pressures remain very strong and are arguably accelerating. The reason for that is that month-on-month price increases were very strong. They had slowed a bit over the summer. You actually saw prices didn't rise at all on net in June. And this time we saw quite a bit of an acceleration there. So it signals that some inflationary pressures are heating up again. The biggest worry was a big acceleration in core inflation to 6.6%, which is the highest in 40 years. You had seen core inflation relatively subdued the last several months, even as headline inflation was rising and rising. And just to clarify for everyone, headline inflation takes into account all prices, including volatile prices for things like food and energy. So headline inflation had been very strong earlier this year because of the big spike in oil prices, especially following Russia's invasion of Ukraine that fed into gasoline prices. And then lately that has eased a little bit because you've seen a little bit of an easing in oil and gasoline prices. But now you're seeing core inflation really, really start to heat up. And so that covers everything else, lots of areas of spending in goods and services that once that inflation really starts to pick up, it's very difficult to stop it from happening. It's actually very much reflected in what we hear from our multinational client base about how, even though you've seen some easing in commodity prices and whispers that inflation could be easing, most of them are still planning lots of price increases for the next year. So that's the reason why you're seeing core inflation heat up. Obviously, that's not just a US story, but the Fed will look at that report and say, we have to keep hiking. They are under intense political pressure to hike to bring inflation down. And they've been seen, as inflation has continued to heat up over the course of the year, they've been seen as having been dangerously and irresponsibly behind the curve on tightening monetary policy in order to bring inflation under control. And so we've actually advanced some Fed scenarios that can be seen in an insight bite on FrontierView.com. So obviously more to check out there if you're interested in this. But this doesn't take us outside our base case scenario. So we are anticipating the Fed will hike by an additional 75 basis points in November, and then by 25 basis points in December, and then hold from there onward. A lot of the reason for that is, obviously inflationary pressures are very strong in the short term, but you are starting to see the costs of tightening Fed policy. The thing is that most of those costs so far have been international, not in the United States. So it's putting the Fed in a little bit of a bind where you've got, growing voices, especially coming from outside the United States, saying, the Fed is just hitting a wrecking ball to the global economy. But unfortunately, within the US, they see the economy is still kind of chugging along okay, and inflation is still very, very high. And so they have to hike.
Got it. Okay, well, a lot for us to discuss and unpack here, but we also are a little bit out of time. So I guess 2 takeaways for our clients. One is really, really pressure test your assumptions about your China plan for next year. Whether or not you agree with us, it doesn't matter. But I think it is really important to have a good sense of what the potential scenarios might look like operationally and from a growth perspective, and continue to prepare for much higher credit costs in the US and outside of it, with all the implications this has for consumer spending, government debt and government spending, and of course your own operational costs as well. Thank you, Elizabeth. A really interesting conversation as always, and looking forward to catching up with everyone next month.
Thank you.